Now, in mistake number 8, it talks about whether or not to roll over 401k or TSP or 403B plans to an IRA account.
Right.
Is it a good idea to move your funds to
Yes.
the IRA?
Yes. We do it all the time. When I say we do that all the time, for those who are eligible for direct rollover, all right, to, or we say custodian to custodian, let me share with you some of the restrictions on employer-sponsored retirement accounts. Okay. Most 401ks, or I should say employer-sponsored retirement accounts, they have limited investment options. So with a direct rollover, a non-taxable event to your own IRA, you have a broader sense of the various options that are available to you to have your money grow, all right? Now, the plan guidelines can restrict the owner's access to the money. Let me give you a good example. Remember the young lady that came, well, she was had retired for about 5 years, and she had an employer-sponsored retirement account just sitting there. And she had separated from service. Okay. Well, she didn't think about it, and I told her, I said, well, you know, even though you've separated from service, if you wish, and let's say she had $500,000 or more, if you took $100,000 out of that TSP, you're over the age of 59 and a half. You're separated from service. The trap would be, there would be a 20% withholding that would come out of that money. Now, suppose you're 59 and a half and separated from service.
What would happen then?
No, let me back that up. Suppose you're under the age of 59 and a half. You're separated from service. You want $100,000. Well, instead of 20%, it's a 30% withholding because you're under 59 and a half and there's a 10% penalty count. All righty. As I mentioned, plan guidelines can restrict the owner's access to the money. You avoid the 20% mandatory withholding. All right. And here's something very important. We've been talking about legacy last few minutes here. Your children and grandchildren cannot elect the multi-generational or stretch option from the 401k or the TSP or the 403B. Any of those employer-controlled sponsored retirement, I'll put that in there. Any event of premature death, let's say the husband and wife pass and the children are the beneficiaries. The employer-sponsored retirement account or the management of that account would require the children to receive the distribution over a 5-year period. Some will restrict them unless we could roll that TSP or 401k into an inherited IRA so that the loved ones, non-spouses, can enjoy the stretch option of receiving that legacy over their life expectancy, okay? Something else too, I utilize the IRA's publication 590. As a matter of fact, I'll show that to our audience today because we're specialists in this area and know how to do direct rollovers, custodian to custodian, transfer from one custodian to the other. And a lot of institutions, banks, credit unions in some sorts, sometimes, for the most part, they don't even allow the Roth IRA conversion. Now, you know that only 7.5% of all the companies in the United States offer a pension.
Yes.
Okay, and you know, so therefore, as I mentioned, we were educated. We're thrust into these 401ks, TSPs, 403Bs. A lot of times, we don't know, we make mistakes in distribution. It's so important to know how to have these monies distributed to you, the owner of the employer-sponsored retirement account, and how it's passed on to our loved ones. The nice thing too is to be, if you're informed, that any event of premature death of one of the spouses, and if, let's say for example, if I passed and I have 401k, you could take that 401k, convert it to an IRA where you own it already, and put that IRA or with spousal continuation and get the funds. And if you're under 70 and a half, you don't have to take a required minimum distributions. Let's say you're 65. So you have 6 years to have your IRA and your deceased spouse combine and take the RMD at 70 and a half. The thing about children though, is that I advocate doing a direct rollover, non-taxable event, control that IRA, all righty? And our non-spouses can elect the spouse option, okay? I'm sorry, the stretch option, okay, or the inherited IRA. But the thing is, they must start taking the required amount out, to call it RMD for your loved one. That amount must be, the asset can be stretched with those payments over the life expectancy of non-spouses. All right. Okay. So that's the difference. And they must take the distribution within 12 months of the decedent. Now with the 401k and the TSP, it's got to be done by October of that year in which the participant had passed, which is could be a father, grandfather, whatever.